Hello and welcome to First Talk, where we simplify super. My name's Andy Jewell and I'm joined today by Daniela and Jason. And what we're going to be talking today is about whether a member should actually contribute more into their super, or should they actually direct that money into their home loan. It's a common question that comes up, and especially in this current environment where interest rates are rising and consequently people are finding their home loan repayments increasing and they don't have so much money in their pockets anymore. But before we start, let's just start off and explain about, well, how is it that members can actually contribute more into their super through something called salary sacrifice? So Jason, can you give us an overview of what that is?
Yeah, so salary sacrifice, rather than getting your wage directly paid into your bank account, you can divert some of that or sacrifice some of that into your super.
And when you're talking about sacrifice, I mean, how do they actually go about doing that?
Yeah, so you can just go to your payroll or your HR and you can say, I'd like to elect for a certain amount to go into the super account rather than into my bank account. And the benefit is that it's only taxed at 15% in the way to super, as opposed to your marginal tax rate. So potentially, depending on how much you're earning, there's a fair bit of tax savings that you can achieve by sticking the money into super.
All right, so Daniela, I mean, what's your thoughts? If you got surplus money, would you be putting it into your super like this, or would you
My
concentrate on the home loan?
thought is that sacrifice is not a word that I have in my vocabulary at the moment. And similar to a lot of our members, I do have a large mortgage. So home loan repayments are my big concern. So I literally can't even perceive allowing some extra cash to go into my superannuation, which is something that I'm not going to be able to reach or benefit from for a long time. So for me, and especially because of the mortgage rates going high and higher every day, mortgage is my main concern at this stage.
Okay, so and we appreciate that with the repayments that are going on, not everyone's got this surplus cash flow in the moment. But if they do, you're saying direct that extra cash into your home loan and get that down as far as possible.
For me personally, yes.
Yep. Whereas Jason?
Yeah, well, I just think, there's so many members that I always speak to and that do a little bit of salary sacrifice, and you know what they always say? I wish I had started earlier. And it's hard to look at, 20, 30 years in the future, but the compounding effects of getting that money into super early really will pay off when you decide to retire.
So, I mean, again, all right, so if we've got this surplus cash flow that we could redirect into super or a home loan, if we're going to put it into a home loan, it is dollar for dollar, isn't it? So every extra dollar you put in, is that the same underneath salary sacrifice?
No, and that's really the main point. It's the main benefit. It's that tax savings. So, if you salary sacrifice $100 of your wage, you actually don't lose that in your pocket. Because you're reducing your tax, you might only lose $80, $85 from your pocket or your take-home wage. So you're sacrificing a little bit, but it's really the benefits of the long-term growth.
I can see the benefits, and I'm just thinking that if potentially we could utilize some of the superannuation to do those extra repayments, maybe our members would be able to afford to do salary sacrificing.
And they can, can't they? So not everybody can, but some members can. Who can?
So you have to reach your preservation age, and then you can start a strategy called transition to retirement, which means you literally access a percentage of your superannuation and can redirect to get rid of the mortgage faster.
Okay, and it's you're saying you've got to reach your preservation age, and we won't go into details out of that at a moment in time. But I mean, is there a preferred age that you can do the TTL strategy?
60 would be great, just because there is no taxation implications around that after age 60.
60. So what you're drawing out of your super comes out tax-free, and you're directing that to your home loan, so you can pay off your home loan and make sure it's paid off
and
by
do
time.
some of Jason's favorite salary sacrificing in the meantime, yes.
All right, so that's great news for some of our older members, and certainly those that are kind of up around the age 60 mark. But maybe for younger members, I mean, they got a very large home loan nowadays. You're talking about $500,000 plus. So, should members be looking at putting their money into super?
Well, you can always start somewhere, and the best thing is that it's flexible. So, your minimum home loan is going to be what it is, and the interest is going to change that. You can start somewhere $10, $20, $100 of salary sacrifice, and you get a pay rise or interest rates fall and you've got a little bit extra, whatever it might be, you can change that. So it's flexible and you can, it can suit what your needs are at the given time.
I guess it's important to just start and see where it takes you and how comfortable you are with it.
Yeah. So in answer, should you put your surplus money into your super or to your home loan? It's really a personal choice, and it's about what's most important to you. So for some of our members, they will focus on their home loan. But to Jason's point, if you're younger and you can put a little bit more into your super, over the longer term, the compound effect is going to make a big difference to what your superannuation looks like when you do reach retirement. If you're older, to Daniela's point, you could look at the TTR strategy and suddenly that gives you access to your super and you could pay off your home loan a lot faster and make sure that is repaid before you do retire. So thank you for joining us today. We may have raised some questions. You may want to ask some more questions around this. By all means, get in touch with the financial advice team. You can go through your local coordinator or our contact centre, and Jason, Daniela, myself, or Richard in Mount Gambier will be more than happy to discuss the options with you. We can also provide a plan that may assist in your particular circumstances as well. So again, until we meet next time, take care.